It's nice to have you with us this morning, and I want to show you what's happening with the Canadian dollar at this hour. The loonie has been a good assessment of what's happening with the Canadian economy right now. The fact that we have seen an erosion in the value of the loonie against the greenback as this conversation around what happens with interest rates has been taking hold. Let's get some more perspective on the divergence in Canada's economy versus the U.S. economy. Royce Mendes is Managing Director and Head of Macro Strategy at Desjardins. Royce, nice to see you. Thanks for joining us.
Nice to see you as well.
How would you characterize the picture in Canada versus the U.S. right now?
So surprisingly different, because typically when the U.S. economy is doing well or when it's doing poorly, Canada is sort of dragged along with it. This time is different insofar as the U.S. economy is doing really well. It's actually maybe doing too well, with inflation proving to be stickier than anticipated. But on the flip side of that, what we're seeing in Canada is, despite the strong U.S. economy, despite the strong population growth we've seen, the Canadian economy is barely skirting a recession. We may have had a little bit more momentum heading into this year, but I think those were driven more by temporary factors than anything. The underlying momentum in the Canadian economy is weak, and it's likely to get weaker as these mortgage renewals keep piling up and as population growth starts to slow down.
How weak are you talking?
Well, we're talking basically very close to a recession. And I think, if there was an unforeseen shock, it wouldn't be difficult to tip the economy into a recession. A lot of the things that have been going well for the Canadian economy over the past 12 months, which has kept us out of recession, population growth and a strong U.S. economy, might actually reverse course in the months to come. And so what's there keeping us afloat at that point?
So let's look at that through the lens of interest rates. Growing expectations that the Bank of Canada will cut at some point soon. Fewer expectations that the U.S. central bank's in any urgent sort of situation to cut rates. But what's your view?
It's not surprising that the Fed and the Bank of Canada are on divergent paths at this point, given what we've seen in the economy, but also, maybe more importantly, given what we've seen in inflation. This year, what the data have shown us is that each of the inflation releases for January, February, and March in Canada have come in below economists' expectations. So really great news. In the U.S., it's different. They've been sort of stuck, and they've come in above analysts' expectations. And so the Fed rate cuts are being pushed out into the end of the year, and some people are saying maybe the Fed doesn't even need to cut rates this year, whereas the Bank of Canada, there's a clear need. On the economic front, we want to fend off a recession. And on the inflation front, there's more room to start to lower interest rates because inflation has made a lot of progress in this country.
And then what does that mean for things like the Canadian dollar?
Well, you think about where the Canadian dollar is today. As you mentioned, it's trading a little bit stronger on the day because of the improvement in risk sentiment. But if you think about it longer term, it's not getting as much benefit as it was from oil prices. We're not seeing, as oil prices rise, as much capital investment in the oil patch as we would have maybe 5 or 10 years ago. So we're not going to get the benefit of higher commodity prices that we would have seen. And we're going to start to feel the pain of this divergence in monetary policy. I think right now, there's a spread built into the market between what's priced in for the Fed and what's priced in for the Bank of Canada. But I still believe that more needs to be priced in. I could see the Bank of Canada cutting rates 4 or 5 times this year, and that's not well priced into markets just yet. So there could be further weakness on the horizon, at least in the next 3 to 6 months for the Canadian dollar because of this divergence in paths for the Fed and the Bank of Canada.
So I guess the Bank of Canada meets again in June, I believe. At this point, what are you going to be watching most closely to determine if that upcoming rate decision ends up being the start of this pivot?
Really, it comes down to the next inflation print. If the next inflation print shows as much progress as these past 3 2024 inflation numbers have shown, I think the Bank of Canada has the door wide open to begin cutting rates in June. Remember that they want to get rates a little bit lower heading into 2025. That's when all the mortgages that were taken out during the very low interest rate period of 2020 start to renew. So they want to ease some of the burden on households going into that mortgage renewal wall. And so I think getting started in a gradual way in June makes complete sense if the inflation data allows them to do so. My guess is that the inflation data will allow them to do so. We've been tracking underlying inflationary pressures in this country across a host of indicators, and they all tell the same story, that underlying inflationary pressures, price pressures are weakening. We're seeing it in the underlying measures of inflation. We're also seeing it in businesses who are not increasing prices as frequently or by as much as they were maybe 6 months ago or certainly a year or two ago.